Hello and welcome to Valualytics, the channel where we search for discounted stocks based on their intrinsic value. Today we'll analyze the pharmaceutical company Sanofi. To do that, we'll use 4 different intrinsic valuation models. Let's get started. So let's see if we can find the intrinsic value of Sanofi. We will start by writing in the stock ticker. And as you can see, the program loads in all the financial data automatically. If we look here at the graph, you can see that the stock price has been quite stable here during the last year. And then recently there's been a huge drop, which was due to the Santic lawsuit and also the failed cancer drug this company was developing. So if you look here at the performance, you can see there's been an almost 19% drop in the stock price the last month. This corresponds quite good to the year-to-date drop, which is also 19%. So is this a good time to pick up this company? Let's see if we can analyze that. If we look at the RSI, we can see that it's close to 24 and thereby under 30, which indicates that the company and the stock is thereby now oversold. But before we go to the analysis, just a short disclaimer. I'm not a financial advisor, I'm just a random guy on YouTube interested in stock analysis, investments and creation of analytical tools. The content of this video should therefore not be considered as financial advice. Remember to always do your own stock analysis and due diligence. The first valuation model we will look at is Graham's valuation, originally created by Benjamin Graham. And you have his original equation here on the left. On the right side you have a revised valuation model. The difference is that the one on the right side uses 7 for the PE of a company with no growth instead of 8.5. And to that is added 1G instead of 2G, where G is the growth rate projection of the company you're looking at. So the revised valuation model is less aggressive than Benjamin Graham's original model. This spreadsheet automatically imports all the financial data for the company you're looking at. And the only thing you have to do is put in the growth rate projection of the company. And one way to do this is to use this link, which will take you directly to Yahoo Finance. And as you can see, it takes you to the analysis page. If we then scroll down to the bottom, we have the growth estimate of the company for the next 5 years. And here it sits as 10.3%. So let's go back and put that into the spreadsheet. And here we'll just write 10. As you can see, we get an intrinsic value of 51.55, which is above the current stock price of 40.82. And by applying a margin of safety of 25%, we will get an acceptable buy price close to $39. And that gives us a sell signal, as that is below the current stock price. But if we change this to 20, then all of a sudden they will have a buy signal, as the acceptable buy price is now above the current stock price. So by applying this model, we get an intrinsic value that is 20 to 25% above the current stock price. The next model we will look at is the comparable company analysis model, also called the multiple valuation model. And the principle behind this model is that you find the PE values of similar companies, and I have here listed 6 different pharmaceutical companies like Sanofi. And then you find the average PE, which here is 24.47, and that is then multiplied by the earnings per share of Sanofi. And that gives us an intrinsic value of 64.37, which is above the current stock value. So even though you put in a margin of safety of 25%, we will have an acceptable buy price of 48.28. And therefore the spreadsheet will give us a buy signal. To find similar companies to the stock you're interested in, you can either use the link in the bottom of this spreadsheet or do your own research. The next model is Peter Lynch fair value model, developed by Peter Lynch. And the principle behind this is that you take the earnings growth rate, add the dividend yield, and then you divide it by the price to earnings. And this spreadsheet is fully automated, so it will load in all the data you need and calculate the fair value. If we look at Sanofi, we find a Peter Lynch fair value of 0.9. And if we compare that value to the table over here, you will see that a fairly valued stock should have a value of 1. And as 0.9 is below 1, we find that the stock is now overvalued. And we can actually rewrite Peter Lynch's fair value equation in order for us to find the fair stock price. And when we do this, we will find the fair stock price of Sanofi close to 38, which is below the current stock price. And if you then add a margin of safety, you will get an acceptable buy price below 29, and therefore the spreadsheet will give you a sell signal for this stock. And this should be interpreted as a not buy signal. The final intrinsic valuation model we use today is the dividend discount model. And here we find the fair value by looking at the next year's expected dividend and divide it by the discount rate minus the dividend growth rate. And down here in the orange field you can write in the dividend the company pay out, and then you can choose if it's a yearly payout or if it's a quarterly payout. And then I've just plotted in the dividends for Sanofi from the current year and 5 years back. And a way to find this data is to use this link, which will take you directly to Yahoo Finance. To find the dividend for Sanofi, we'll need to change these parameters. So we'll just change it to monthly, and instead of historical prices, we'll just change it to dividend only. And to get the last year's dividend, we'll just have to change this interval, and we'll just choose a year some years ago, and let's take 2015 as an example. And let's take it from January and the 1st, and then just hit enter. And then we just need to push apply. And as you can see, now we have the dividends for the last year since 2015. So that is actually just the data I've plotted into the spreadsheet. As you can see, we find an average growth rate of the dividend of 5.56. And I've then just added a little bit more conservative growth rate of 5. Over here in the orange field, you have the option to take the average growth rate or the custom growth rate. So you can choose that for yourself. And that will change the intrinsic value. And then, of course, you would also have to put in the discount rate. And I've here set that to 8.5 for Sanofi. And then you'll find a fair value of 61. And if you then put in your margin of safety again, which again I've set to 25%, you'll get an acceptable buy price of 45.9, which is above the current stock price, and therefore the spreadsheet will give you a buy signal. In the last page in the spreadsheet, you will find the summary and watch list. And this will give you a summary of the 4 different intrinsic values you have found for this company using these models. And if you compare the models, you can see that the only one that falls out is actually the Peter Lynch dividend adjusted fair value model. So if we want to exclude that, we have the option to do so. But I like to include it because it will make the final average intrinsic value a bit more conservative, as it will lower the average. So if we look at the average intrinsic value, we found it to be close to $54, which is above the current stock price. But if we then add in a margin of safety, we'll get an acceptable buy price of $40.49, which is just below the current stock price. So if we change this to 24 instead, we'll get a buy signal. So you can say by taking a margin of safety of 25%, you're really close to still getting a buy signal for Sanofi. So that could indicate that the stock is actually undervalued right now. But of course there's a risk with this stock at the moment due to the Zantac allegations. And that is reflected in the stock price. But let's change the safety margin back to 25, and then we can add it to our watch list to follow this stock and see if it falls even lower. And as you can see, we already have Stanley Black & Decker at our watch list because we analyzed this stock last week. And now it actually has a buy signal, as the stock price fell even lower during the last days of the week. But now let's add a Sanofi to this list. We'll write in the ticker, and it will just load in the data. We will then write in the date and the margin of safety, which is 25%. And then we'll add in the average intrinsic value we found, which was 53.99. And the stock has now been added to our watch list, and they will automatically give a buy signal if the intrinsic value plus the margin of safety falls under the current stock price. And I will of course update the watch list available at our Patreon site to also include Sanofi. This intrinsic valuation tool is available on my Patreon page together with other tools for stock analysis and portfolio tracking. If you like this video, please hit the like button and subscribe to this channel in order to get more content like this in the future. And until then, have a nice day.